Well, greetings and welcome to the June 2024 Investment Strategy Brief. In this episode, I basically want to get into what's coming into focus as we look into the second half of this year. So let's jump into it. Let's start with the idea that there's been this sort of optimism embedded in the environment, really around artificial intelligence. So we've talked a lot about what it is, what generative AI is, how we're seeing economic impacts, and how it's influencing competition. We've created a little bit of a framework on investing with enablers and innovators and disruptors. To get specific to the economic impact, this optimism is really centered on the idea that we're going to see, huge numbers, $15 to $16 trillion in extra GDP, maybe between now and 2030, based on certain studies, from either improved productivity or maybe I should say, enhanced products or new products, right? So just a lot of new value added. That's a lot of optimism sort of embedded in the environment. And that's meant that, basically the economy is growing further and faster than anticipated. So here we see the economy growing basically back to the trend line from before the pandemic. And the other thing I like to point out on this chart, like I've done before, is that big blue box. That's showing us that about 2/3 of the economy is really the consumer. So from consumption or the consumer. So where the consumer goes is really, really, really important, and we're going to get into it. Now, as it relates to the Fed and interest rates and so forth, there's a keen focus on inflation. So here we see consumer price index and producer price index, basically a monthly, 3-month rolling average of CPI and PPI. And what we can see is that these numbers have sort of cooled back down towards and sometimes below, in the case of PPI, the Fed's 2% target. This green line is actually 0.17. That's the monthly equivalent of the Fed's 2% target. And so inflation has improved some, and the Fed's made note of that. In any event, when we dig into the numbers and the components, the one category that just continues to stay in focus is shelters. So think rents or owner equivalent rents, where shelters, those increases are higher than people would like to see, and the Fed's watching for a slowdown as it relates to shelter. So on the Fed, we've had a number of meetings, and the punchline is that the Fed continues to send its message. We're not going to cut rates anytime soon. We want to see inflation get better and show a sustained pattern towards getting better for a period of time. And so the Fed basically is saying, hey, we're going to keep our Fed funds rate higher for longer. Now, we did in this most recent meeting, get their latest summary of economic projections. And, basically that sort of reinforces this idea. They're seeing the economy remain strong, unemployment remain at a reasonable level, inflation cooling, but not yet back to its 2% target. And with all of that, now them saying, hey, maybe we'll cut one time. The median forecast among officials is for one cut, a quarter point between now and year end. And in fact, when we look at the pattern of the market, basically, we know we started the year by Fed funds futures indicating that people were super optimistic the Fed was going to cut a lot. And as we've moved through time into mid-year, that sort of optimism has faded. Now the market's sort of up there is thinking essentially 1 to 2 cuts, and you can see that recent move for the Fed. They for a period through their prior SEP had said 3 cuts this year. They moved back to 1. So that move up of the green line is this most recent change. And, the punchline is anyway, we're in an environment that is higher interest rates for longer. And we've talked about this before, but this fiscal transition. So the market between the Fed funds translating to the 10-year Treasury, but also those forward rates embedded in the curve. They're basically saying the 10-year is going to, for example, be higher for a lot longer. When we couple that with this increased debt that we've seen since the financial crisis, that means we're setting up for this stress with the consumer, businesses, and our government to reconcile those two things, the higher cost of debt as debt has gone up. So we'll keep an eye on that, as we've talked about before. And in fact, let's turn to the consumer. So the consumer's been very active, been sort of contributing to the economy much more than people might have anticipated. Part of that is optimism around the labor market. So this chart, this blue line, shows the drama of sort of the pandemic shutdown and then the reopening, where really for a period of time there were actually 2 jobs for every person looking for work. That's come down some, but you can see there's still a ways to go to these horizontal lines. The gold one being the 20-year average, and the one right below it being the level right before the pandemic. And so think of it as still a tightness in the labor market that is sort of increasing wages, and it's basically giving the employee, the worker, basically feeling a little bit more confident, and that's been one driver of consumer activity and consumer spending. In any event, though, when we look at things like earnings reports, so when you look at companies like McDonald's or Pepsi or Amazon or Citi or Starbucks, all of these have sort of comments in there about sort of strain or stress or issues that they're seeing with the consumer. Consumer might be a little bit more selective in what they're buying, but also another related threat is that the lower income consumers is feeling a bit stretched. These are the kind of the analyses that come out of these earnings reports. So it's another point of evidence in terms of the consumer slowing down a little bit. When we get to the data, we have seen a softening of retail sales. We've certainly seen sort of a negative move both in sentiment and confidence in the consumer, and we've seen a little bit of an uptick in delinquencies when it comes to auto and credit card loans. So overall, we're calling for the consumer activity to slow down a little bit, and we're starting to see data that reflects that. Now, overall, I'd say the view on the economy, both here for 2024 and even into 2025, remains pretty positive. And the Fed, even in its summary of economic projections, included a forecast for the economy for this year and next. And the bottom line is these are pretty lofty numbers, and we think maybe 2024 does play out this way, but we're expecting a slowdown, a bit of a slowdown in the second half of 24 and into 2025, anchored to a good degree on this idea that the consumer activity is going to slow down a little bit. So again, we'll keep an eye on that. But that's some about the economy and where we're headed. Now, this month, I want to get into a little bit more detail as we sort of set up for November and our elections in the U.S., essentially a little bit more of a discussion on elections around the world. So recall that we're in a global election super cycle. So there's 40 nations, really 40% of the world's population going to the polls this year. And so, each area, each region, each country, it's going to be sort of complex in each case, right? Each sort of political system or structure, different parties, et cetera, and issues that are in play. All of it's fairly involved. But what we try to do is take a step back and look for some common themes and some common concepts, if you will. And so those that have sort of popped out with these elections include economic opportunity, of course, people wanting to be elected, sort of explaining their platforms for improving the economy and improving sort of the lives of the voters. That's translated some to the idea of protectionism, so the idea that candidates are going to take better care of the local population. And then we do want to keep an eye on trends and issues, individual issues that we see around international relations, a lot with the U.S. Trade with these countries and regions, but also our competition in that regard with China. So these are some of the things we're watching. And as I've said before, while it's logical to watch the major economies, we're also watching some of the developing economies because they're growing and will become major economies in the future. Now let's get into a few of the specific elections and start with Mexico. So the left wins a large majority. Claudia Sheinbaum basically won by 30%. On a platform that includes continued support for what current President AMLO calls the fourth transformation. So this is a really ambitious agenda in Mexico to transform its political, economic, and social landscape. And the focus is really on managing or controlling corruption, on social programs, national economic development, security, and energy sovereignty. So, that's sort of a significant thing. There's been success there, and essentially the person supported by the current president, AMLO, has won. And now an interesting thing is, given everything that's gone on in the wake of the pandemic, there's been this idea of near-shoring, where companies will take their need for production of goods, as well as just supply chains, and kind of find locations closer to their shores, so nearshoring. And of course, in the U.S., that means we've dived a little deeper in with Mexico, with a lot more cooperation in terms of companies in Mexico. And our companies, again, installing factories and things like that. And so the bottom line is this election basically probably strengthens that situation in terms of the support, because it brings economic benefit to Mexico. And I'd also say another sort of dimension here is we know that there's a lot of focus from the U.S. on sort of illegal immigration coming across the border from Mexico. And so the U.S. expecting cooperation to strengthen border enforcement, basically from the Mexico side, and so we believe that Claudia Sheinbaum will be supportive of that. Now, moving on to India, this is an interesting one. It's a right-leaning sort of current base of power with Prime Minister Modi, who is re-elected to a third term, but his party basically lost majority in the parliament. And so while there have been improvements in India, there's essentially still a continued focus on very high levels of unemployment and a sense of inequality. So this shift that's happened is sort of unrest, if you will, around those issues. And as it relates to international relations, of course, we have a pretty good relationship with India, but they really are trying to appease both us and China. So China's in there, and China's in there competing hard. Now, moving on finally to the EU. This is interesting in the sense that there was a little bit of a shift, if you will, to the right. So sort of center-oriented candidates have held seats. Essentially, far-right candidates have gained seats, and that's at the cost of seats from the Renew and Greens that have lost 41 seats in Parliament. And that's viewed as really two issues that have come to the surface. One is really migration, so countries around the EU, people moving to the EU, migrating in, and the stresses that puts on local populations and so forth. And then the second, interestingly, is a bit of a pushback. It's early, but some pushback on climate change initiatives, really the cost of those, right? So, these lofty goals that the EU have had, it's coming into focus that those are likely not going to play out because the cost is high and people are pushing back on that. So again, an interesting set of results for the EU. And I'd say as it relates to all this and the U.S. elections, kind of the high-level observation on the U.S. elections is it's really a little bit right now too close to call. So, we sort of evaluate and try to understand all the different possible outcomes. And there's even talk that one that could happen is the mirror image of where we are now, where the presidency and the Senate go to Republican and the House goes Democratic. But it really, in each of these three sort of categories, presidency, Senate, and House, a little bit too early to really call the election. But the learning from abroad is that the possibility that we could have a significant move, the emotion, the polarization, if you will, in the environment could cause voters to really shift in one direction or another, but it's really unclear at this point, which direction we're going in. As it relates to issues that we're focused on around the election, there are a group of things that we think will be highly dependent on the outcome of the election. So think trade policy, tax policy for sure, maybe immigration in terms of how tough we're going to be, then the idea of how much regulation we want, as well as environmental policy. Two areas where we think things will sort of stay where they are regardless of the outcome include the idea of deficit spending. Unfortunately, at least in my view, that's a little too extreme right now, but the idea is that there's going to be continued high deficit spending regardless of who's in office. And then the other, of course, is it's sort of become in vogue to be tough on China. So we'll be tough on China, whoever wins, it seems. So that's, a little bit about the elections, but again, so far too close to call. Okay, let's turn to the markets. And what I want to do is focus first, as we do, on interest rates in the bond market. So right now, basically what we see is that the 10-year Treasury sits around 4.2 to 4.3%. It started the year at 3.9%, so up just a little bit. this year, and that idea of higher for longer. And what that means, what that translates to, is that bond market yields, different categories of bonds shown on this page, are showing attractive yields for investors putting money to work, which we view positively. I did want to point out this time around on the far right of this chart, we have a couple bars. It's the MOVE index, and this is an index that tracks the volatility of the bond market. And you can see it's a little elevated compared to the 10-year average. So we as investors have experienced this, right? Rates are moving around a bit, bond markets moving around a little bit. So it feels just a little bit more volatile than it's been for the last 10 years, but it's just something we've kept an eye on. Now, I want to switch gears to the equity market and keep a focus on volatility. Now, these are noisy series. The VIX and then the CBOE's dispersion index. And let me try to explain. The VIX basically is a metric that captures the view and kind of expectation of stock market volatility. And what we've experienced with this is that market volatility sort of top down has really fallen. So while it's noisy, you can see this decline down, this move down. And then for dispersion, for a period of time, we saw something similar, right? And dispersion, by the way, is sort of how stocks are moving around compared to one another, how wide the range is, if you will, in terms of the movement of stocks. And basically, that's been declining as well until recently. All of a sudden, it's sort of popped back up. And so you can see on the right, we're basically taking dispersion and subtracting VIX. But the takeaway is really this. It's this idea that when we look at top-down numbers and we watch things like the S&P 500 or the Dow Jones or the NASDAQ move around, the sense one gets is that things are fairly stable in terms of traditional market volatility. That said, when you look under the hood, and that can be experienced if you own a bunch of different individual stocks, all of a sudden what we're seeing is that stocks individually can be moving a lot. And so it can feel almost uncomfortable to have a sense that the environment overall is stable, but have some of your individual holdings going down a lot or even going up a lot, and that feels a little bit unstable. And so that's a point that we've been teasing out and sort of running numbers on, and certainly spending some time working and talking with our financial advisors and our clients about the concept. But it's something to be mindful of, that what feels top down is sort of stable can actually feel a little unstable if we dig into individual positions. Now, for the equity market overall, valuations remain elevated. So, we're a little over 20% at a premium above the 10-year average in terms of PE. We've talked about that being driven to a good degree by the Magnificent Seven performance, and essentially that's tied to earnings growth. So almost 30% earnings growth expected in 2024, and then an ongoing longer-term growth rate of 23%. But just think of it as elevated above the rest of the companies in this case the S&P 500. And that's led to higher multiples for the Magnificent Seven, that PE multiple. So as we've talked about before, when we sort of relate those two things, it's called the PEG ratio. Take PE and divide it by the growth rates. In this case, the longer-term growth rate. Essentially, you see the bars are kind of even with each other there on the bottom right. What that's telling us is when we adjust for earnings growth, then valuation is kind of consistent between the Mag 7 and the other stocks. But it all is a little bit richly valued compared to history. And so that's just something we have to keep an eye on. We should expect a little bit more volatility, maybe some downward moves, but we're not tactically calling for a bear market or anything like that. We think that, again, the environment's going to stay reasonably positive, and long-term investors should remain invested. As it relates to the pattern of performance, that pattern of that larger cap set of companies, the big tech-oriented companies influencing indices like the S&P 500, essentially the Mag 7, in this case by the Bloomberg Index, up almost 37% year to date, the S&P 500 up 15.5%, whereas the equal weighted, where we neutralize the effect of the big companies, it's actually up 5%, which honestly is still a decent number, but that differential has a lot of people's attention. And you see things like even small cap stocks, in this case, is measured by the Bloomberg 2000, just a little bit below zero. So there's just this big kind of difference in performance by segments of the market. And yet one has to be a little bit careful to not run away from some things and into others, because these patterns tend to move around. And so that's something we are regularly kind of talking to folks about. And in fact, we talk a lot about diversification, that it really is beneficial to have exposure in many of these different buckets. So again, that's a little bit about market performance. Oh, one final thing, which we looked at last time. This idea of cap versus equal weighted, it's easy to say, oh, what's happening right now is going to go on forever. But when we look at history, these two types of indices and ways of investing come in and out of favor. And so it's almost like once you think, oh, cap weighted is the way to go, we could end up in a sustained period where the equal weighted approach ends up doing better. So again, something to just be mindful of, to be careful not to capitulate, if you will, away from one strategy and into another. So as we look forward, I'll just mention we do have in focus geopolitics, right? The risks going on around the world. That includes U.S.-China competition. That includes, essentially just the recognition that we have to be mindful of things, like cyber attacks. There's the fiscal transition that's captured in financial instability, the idea of higher rates and higher debt. And then, all kinds of things, of course, unfortunately, going on from a military perspective, really all around the world. So these are things that, as we've talked about before, we're monitoring and trying to keep track of in terms of how it influences our economy and our markets more broadly. We are, of course, working through all the data that comes in on some of the things we've talked about. So inflation, interest rates, consumer, Fed policy, et cetera. Just a lot of information coming at us, as if you will. And it's just the kind of thing that we're watching as we make our way through the second half. Hey, listen, I just want to take the opportunity to invite you once again to check out stiefelinsights.com, a place you can go to get things like this video and many other things, the work that we produce. Thank you so much for checking out this episode of the Investment Strategy Brief, and we'll see you in July. Thank you.